What we know is a drop. What we don't know is the ocean.
Hello and welcome to the Newton Knowledge Podcast. My name is Mark Singer, partner of Newton One Advisors, and I'm joined by our managing partner, Steve Target. The Newton Knowledge Podcast will provide meaningful content to our valued advisor community. Our discussions will deliver unique insights into the people, processes, and products that make our industry so critical. Newton One is a national life insurance planning firm delivering customized solutions structured to help clients and their advisors engaged in solving estate planning, wealth transfer, business succession, and executive benefits challenges. We are a member of the M Financial Group, which grants our clients access to the nation's elite carriers and exclusive products available only through our network. Today we are with Brendan Flatow, managing partner of Evergreen Settlements. Brendan, how are you today?
I'm doing very well, thank you.
We're excited to be here. Thank you for having us in your beautiful office. Tell us a little bit about yourself and your firm, and then we'll dive into life settlements.
Yeah, well, first, thank you for being here. I think this is a great opportunity for me, and I'm excited to spend time with you. Like you said, I'm one of the managing partners of Evergreen. I co-founded it with another gentleman named Jonah Kahn about 9 years ago. And it's a classic story of having great partners and great relationships. And we've been able to grow the business substantially over the last few years to one of the largest life settlement brokers in the country, working with high-end financial advisors and fiduciaries across the country, helping them access a relatively complex market space to be an advocate for their clients and for sellers of policies. Evergreen helps people sell life insurance policies that essentially become unwanted or unneeded as an alternative to your traditional non-forfeiture option. So this is exciting for me. I get to talk a little bit about our business in a marketplace that I find exciting and that's growing exponentially every year. And on a personal basis, this is exciting for me because I really enjoy working with advisors like you because I think this is such an important thing to do, such an important thing to talk about and protect our clients' assets. So thank you for having me. A wonderful opportunity, hopefully, for both of us.
Great. So you touched on it a little bit, but can you take us through the life settlement process from start to finish and what that actually looks like?
Yeah, I think it's important to understand really the genesis of the market and where it came from. Traditionally, when somebody bought a life insurance policy, they bought it for a very specific purpose, and it was to provide financial security for their family or potentially for their business. But over time, we know that things change, whether it's with business planning or with families. So having an alternative to traditional non-forfeiture options, really is, I think, it's a great strategy that can be employed to create value and economic benefit. When the market was created, really from an institutional standpoint in the late 90s, there's sort of a story that I always tell that was a tipping point. A CEO of a large company here in Philadelphia had a large $25 million key man policy. And because his health had changed, he was stepping down from the company. And one of the benefits that he got is he got to keep this $25 million key man policy. He didn't really see it as insurance. He saw it as $1 million cash surrender value and something that he was going to place in trust for his grandkids. We sat down. The advisor who sold it, who I was working for at the time, he went and talked to him, and they brought in sort of the full circle of advisors, the CPA, the attorney, and they talked about the life insurance and being big proponents of life insurance and why people should keep the insurance. We talked to him about why it was the most valuable asset potentially he had. Right, his health had changed. He was going to pay far less premium to get the same net death benefit, and he should keep it. And the attorneys and the CPAs and everybody sort of nodded in concert, and everybody agreed. And then ultimately it came down to the fact that he wasn't willing to pay the premiums. He wanted to surrender the policy, and that was the strategy. Collectively, we knew that there was a secondary market where people were willing to buy life insurance policies. So we went out, we talked to those potential investors, and we kind of figured out a couple things. One, we were able to find somebody that was willing to buy the policy for $3.5 million. Clearly, that's an economic benefit to the seller.
How much was the death benefit?
It was a $25 million policy. He was about 71 and had relatively minor health issues. But the amount of premium that was going to be required to keep that policy in force was significantly less.
What was the actuarial data stating his longevity?
So his longevity, it was because there is some relative subjectivity to it.
Yeah.
It was anywhere from 14 to 16 years.
Okay.
Which is sort of interesting because, I don't want to get too far. I'll tell you what's interesting about it in a second. So we were able to figure out that somebody was willing to buy the policy. And the sort of two conclusions that we raised is we weren't real comfortable selling the policy to the people who were willing to buy them. And we weren't really sure that there were a lot of protections in place to protect privacy. And we talk about that story a lot, and a lot of different people tell it, and there's slight variations to it. But it really was the tipping point to establishing institutional relationships so that if we, as advisors, if that advisor had a client who had that situation, well, then there's a good chance a lot of other people did. So that sort of launched the idea of bringing in institutional capital, being able to put in process and mechanisms to protect privacy, and to sort of evolve a marketplace that needed evolving. So, I talk about that as sort of the tipping point. And then you saw the market grow really exponentially from there because advisors and fiduciaries are pretty smart. And they began to realize where the opportunities were. And your traditional non-forfeiture options of either lapsing, surrendering, extended term, maybe a guaranteed paid up policy, there was a secondary market option now available. And really the market had been established in 1911 when a Supreme Court decision of Grigsby versus Russell established the fundamental property right of a life insurance policy. So you're always able to sell it. The problem was, who are you going to sell it to? Right? There was no sort of collection of willing buyers and willing sellers that would have given you fair market value. And as the market grew and we began to educate advisors across the country on this as an option, we really saw people latch onto it and find a lot of different sort of niches and how it might apply. So what started as a lapse or surrender alternative really became a financial advisor strategy to be able to supplement retirement strategies or pay for health care. But really, it established life insurance as an asset class. And I think that's a big deal.
Yeah, it's a big part of our business for sure. Are most of your engagements around that $25 million death benefit spectrum, or is there a minimum, maximum? What are you traditionally seeing at Evergreen?
No, and it's interesting because we tell that story, and the life expectancy ended up being much longer. When policies in the early 2000s, life expectancies for purchasers were around 2 to 10 years, right? And they were looking for people who had relatively significant changes in health, and the market wasn't that big. But over time, now we see life expectancies sometimes out beyond 20 years because people and actuaries and the pricing models, and the market's grown, so you can afford to be think further out. But after the financial crisis in 2008, when credit facilities dried up, you saw a lot of changes, right? Well, the positive after that was that there was far more institutional capital that was injected into the space. Because when those credit facilities of existing portfolios dried up, we saw a lot of institutional capital come in because, right, everybody was looking for yield in a low interest rate environment. There was portfolios that essentially were distressed assets where they could come in and buy these existing portfolios for dimes on the dollar. So once that capital came in, you really saw that they got sort of the hip to the idea of what the space was, right? Non-correlated asset class could be considered an alternative. It was relatively downside protected, right? Because the death benefit's always going to pay out. I won't say always. We'll put an asterisk on that, but we hope it does, right? And so you saw the institutional capital came in, which allowed people to be more aggressive. And recently you've seen, instead of sort of the value being predicated wholly on the change in health, where it's, we see investors say, well, if you have a really efficient policy, something that was issued preferred or super preferred, or even a GUL contract, well, we want to buy those too. So after 2008, really after 2015, when all the capital was really resonant, you saw people create niches, right? They were only going to buy GUL. And with that, we saw policies from anywhere from $100,000, up to, there really is no limit on what people are willing to buy. That sort of answers the question. What we typically see, universal life policies really make up a bulk of the market. And it makes sense if you think about it, because there's so much flexibility in how you manage that, and you can optimize premiums, where with a whole life policy, you have to pay the illustrated premium. So it's designed to be a cash accumulator. You have a lot of cash in it, especially as they get older, where a universal life policy, you can manage that. And especially like GUL contracts, where you can optimize the shadow accounts and some of the secondary guarantees. And that's sort of where buyers can begin to differentiate themselves, because the products better, you're more efficient in how you can manage it, and then you're willing to adjust maybe your rate of return in order to be aggressive.
Talk to us about that. You said maximizing.
So maximizing the efficiency. So
about the shadow accounts and.
Yeah. So every policy's value, there's a lot of factors that goes into it, but essentially the value is predicated on two key factors, right? The health of the insured and the amount of premium that's required to keep the policy in force. So said differently, it's, how much premium has to be paid and for how long. And if somebody's had a change in health, well, now you might be paying, instead of paying premiums for 20 years, you're going to pay it for 10 years. So just think of the pure economics of time value money, how long you have to wait, and the policies, what's the current value of the future death benefit? Well, if you're getting it in 10 years versus 15, right, that arbitrage has been created. So when you look at any particular policy, some people might look at the illustrated premiums, or they might look at it a little bit differently. But the better you are at being able to determine how efficiently you can fund a policy, and also the better you are at medically underwriting, the more valuable that policy becomes. So when we created Evergreen, one of the most important things to us was process, right? And identifying process, because the difference between a few basis points or 6 months in underwriting, that all impacts the value of a policy. So when you want to understand what a policy is worth, the first step is obviously to identify a need, right? Somebody who doesn't have a need for the policy, it's underperforming, they've made that decision. And statistically, we know every year about $120 to $140 billion of death benefit is lapsed or surrendered on insureds over the age of 65, right? So these decisions are already being made. This isn't us suggesting to somebody, hey, you should sell your policy. No, what the suggestion is, you've made a decision. Hopefully you've consulted with your advisor or your fiduciary. What we want to do is help you extract the most value.
You're just leaving assets on the table.
You're leaving assets on the table. And a lot of people don't think of life insurance as an asset, right? It's not necessarily actively managed. So you have this asset that might be the most valuable asset in your portfolio, but you're not really thinking about it. And the catch-22 on that is that if you were talking about that asset being a piece of real estate, right, or stocks, securities, bonds, it's really easy for the financial advisor to know how to monetize or liquidate that, right? And then not only are you going to monetize and liquidate it, you're going to reallocate it. So the same is true for the insurance if the questions are asked. Right, so this might be an extremely valuable asset if the business is sold, if the kids have grown, family dynamics change. But out of that 120 or 140 billion of death benefit, it's like 500,000 policies, right? The decision's already been made to get rid of it. So we want to make sure that from a process standpoint that we're helping them extract as much value from it as possible. And that's why I think process plays such an important role.
You talked about the market changing. You referenced 2008, you referenced 2015. Here we are in 2024. What do you think about the market moving forward? Is the institution, are the dollars, is the capital coming into this market, are they still fluid? Is there enough? Is there more? What do you see moving forward? I know it's maybe tough to predict, but what's your guess about what's going to happen with this market?
So Coney and Companies it does studies, and they talk about the growth of the space. I think if you just look at the pure demographics, right, every year, right, there's 55 million people over the age of 65, and everybody talks about, right, how many people are turning 65 every day. So you have demographically, you have a huge pool of people in this sort of space, people who will qualify. You also have people living longer. So the need for liquidity and to be able to subsidize retirement, create liquidity, all of those things are increasing. And capital is really becoming smarter and smarter about how they invest in the space. So, I'm very bullish. I think that there's just a tremendous opportunity that, if you look at the amount of policies that are lapsed or surrendered every year, and statistically 90% of the people who lapsed or surrendered it said they wish they knew they had this alternative, right?
Makes sense.
So it's so important to us to tell the story because there is so much opportunity. And over the next decade, we know that just for business owners, right, that over the next decade, as the silver tsunami approaches and baby boomers retire and continue to age, that there's going to be trillions of dollars of wealth transferred. And a lot of that is in small, privately owned businesses. So in the next decade, 12 million businesses are going to be sold. And I say that because if you think about how many key man policies, buy-sell agreements, how much insurance is owned by businesses, are they thinking of it as an asset? Are they leaving money on the table when they, sell the business? And I'll tell you a great story. So it's a business from Michigan. Two brothers are selling to two daughters, right? And they did it over a 3-year period where the buy-sell policies essentially became key man because they were going to do a slow step sale of the business. Each brother had a policy. The daughters who were taking over the business really didn't have a want or a need for it. It also became somewhat of a burden if they were to maintain it because they were purchased as term. So as the brothers got older, they didn't need the insurance anymore. So rather than look at that as a liability, they were able to actually sell those policies once the sale of the business was complete. And it was sort of twofold. One brother sold his $1 million policy for about $465,000. The other brother about $250,000. So they created liquidity for the business, helped with the transition, and it was a win. And one of the things that really was the great win is the advisor who worked with the generation 1 wasn't sure how sticky his relationships were with generation 2. But because they brought this concept, they helped with execution, they were able to show, how forward thinking they were able to maintain those relationships. So they didn't lose a client in that transaction.
Who regulates this industry?
So it's great. It's one of the reasons why so much capital came into the space was because it's a very well-regulated space. Just like in the rest of insurance, it's a state-by-state. NCOIL, there's different model acts that have been in place. Almost 92% of the U.S. population lives in a state that's regulated. So it's a very accepted transaction. It's well-regulated. Capital feels very secure. And I think without regulation, you tend not to get capital.
Who's regulating it? Is it the banking industry? Is it
No,
insurance?
it's insurance commissioners. Yeah,
Interesting.
It's an insurance transaction. So, a separate license is typically required.
Yeah.
But if you've had your life license in most states, you can get you can either get it added on or you get a separate license. It's one of the things that makes it such an attractive space is how well regulated it is.
When you're negotiating the offers with different sources, they're looking at the actuarial tables. They're looking at the way the policy was designed. They're looking at the health of the insured or the insureds. But what other levers are in there that impact what the offer is?
Yeah, I think that the key to maximizing value is competition, right? Because it's like anything else. Competition drives value. And if you were to go to a single life insurance company, or if you were to try to sell your house and you only had one buyer, right, the value is going to be limited to either what they're willing to pay or what they think the value is. But the more people you bring under the umbrella and the more competition you create, that's really where the value gets created, right? And that's how it's driven. So we might get $4 million policy. We may get 35 different bids on that policy. And that doesn't mean it's 35 different buyers. The first bid might be $150,000, and the last bid might be $750,000, and it's the same person, right? So, each buyer, and it's so important why, from a fiduciary standpoint, that sellers have help navigating this space, right? Because it seems like a simple concept, right? You want to sell your life insurance, you want to buy it, okay, the easy transaction. Well, no, it's not. Right? Selling a policy to somebody is a lot different than selling a policy for somebody. It's very important from a process standpoint, and it's part of the process that we created was that you want to make sure that you review all the medical records. Are there gaps in there? Was there reference to a follow-up that we don't see evidence of? Are they scheduled for a follow-up colonoscopy on the 18th? What should we do to make sure that we're doing everything we can on the medical underwriting? Are we getting a premium history, a copy of the policy, annual statements to make sure we're maximizing guarantees? So each buyer, will look at it a little bit differently. Some are far more sophisticated than others, but that's just the reality of an open market. So if you work with institutional buyers, you have somebody who helps navigate it, who's an advocate for you. And it was really one of the driving reasons why we created Evergreen, right? Buyers are represented by years of experience, teams of actuaries to help the investor get maximum value. So who's helping the seller? They look at it and they're like, I can do this. I'm smart. I've run a business. I'm super successful. And I always kind of laugh and I tell the story that, I went with my wife. She wanted to buy a new car. I did all my homework. I was on the internet. I had my notes. I went in. And as soon as I sat down and started talking to the guy who'd been selling cars for 40 years, I was like, I wish I knew more, right? Because I wasn't sure what was going on. I don't think he was giving me a bad deal. But I tell you what, I wasn't as confident as I could have been had I had somebody that just does this. And I've been blessed with, having wonderful partners. And we've built a team that has a collective 150 years of experience dealing with the settlement side. So we're able to balance out, the scales so that when your client goes to sell it, they have the same level of expertise that the buyer has. And we're able to maximize value. So like I said, you could go to one buyer, and I'll give you another. I'd love to tell stories today. So I had a referral call me. He was an attorney in California. He said to me, hey, I was told that you can help me. My dad has a $400,000 policy. It's in a trust. They don't need it. I've got 3 siblings. Everybody's fine. My parents need liquidity. I'd rather them just stop paying premiums. It's too expensive. And we kind of go through, and it's a very traditional story. He says, but my dad went to a buyer, and they offered him $14,000 for his policy. And he said there was $4,000 of cash. So he's going to net out $10,000 and he's ready to do it. But my friend told me I got to talk to you first. I said, great, it's worth more. He said, well, how do you know? I said, because he only went to one buyer. So we ended up collecting the medical records. We did the due diligence. We ended up shopping that policy and we sold it for $135,000.
Wow. What are the tax implications of that $135,000?
So that's a great question too. So not a tax advisor, but I can certainly walk through how the market perceives it. And the 2017 Jobs Act really clarified it and actually made it more beneficial for sellers because they redefined basis. But if you sell a policy from zero to basis, there's no tax consequence.
Makes sense.
So you get your money back. If the policy's cash surrender value is higher, if the cash surrender value and the account value are different, you're going to pay ordinary income. But most policies you're dealing with zero to basis, nothing, above basis capital gain. Just because you don't see a lot of policies where the cash surrender value exceeds basis. Now, low interest rate environment, you don't see that a lot. So most policies you're either paying just capital gain on anything above basis, that's it. And if it's below basis, then you're not paying anything.
Once the policy is sold, are there any requirements that are followed up with to the insured? Do they have to submit any additional medical records? Do they have to answer any questions? Do they look outside and there's a black limousine parked in front of their house? I mean, what happens after that policy is sold?
That's a good
so
question.
It's interesting, and it's funny you say that the black limousine out front. When I first got into this space, early 2000s. The chief objection we had to deal with was what I called the Tony Soprano objection, right? The Sopranos, it was a big HBO show at the time, and people had that question. And it's interesting that we don't really get that anymore because so many people are so much more familiar with the space and the option, or at least their advisors are. And I think it's because it's an institutionalized space, because most of these policies, the return on one is irrelevant in terms of the larger portfolio. It's law of large numbers. So the ongoing, because it is an investment and because it's part of a portfolio, there is some ongoing, maintenance, right? They need to know if the insured passed away. They don't want to continue to pay premiums. So there are quarterly tracking calls. They might be less if the insured's younger. But they'll call, and essentially somebody might call, and the only question they ask is, has the address changed, right? So they'll do tracking calls, but there's no labs, there's no additional underwriting. The health is really just derived from, or the life expectancy is derived from medical records. Now when you sell the policy, within the contract, you are allowing the new buyer to update medical records the same way they'd want to update a portfolio to see how it's performing, whether they want to invest more or less, how they want to allocate it, because the portfolio itself is really based on that law of large numbers, right? They're going to have some males, some females. You don't want over, carrier concentrations. You want to make sure that you've got diversity of risk within that portfolio. And then with the underwriting, some will live longer, some will live shorter, but most will be in the middle. And that's why the individual policy really doesn't impact the portfolio for institutions anyway.
Aside from creating competition and I'll call it a bidding war for certain policies, what else should a potential prospect of a life settlement or the advisors working on their case be aware of?
I think that the word aware is probably the key. Right? We have to create awareness. I talked to a friend the other day and we were kind of joking around. He goes, my dad just bought a life insurance policy. I said, well, why didn't he buy it from you? He goes, that's what I asked him. He told me he didn't know I sold them. And he was just a financial advisor. And I sort of laughed, but it reminds you, and we've all been in that situation, we got to tell our story. And I think if we're not telling the center of influence and the CPAs and the attorneys and the other fiduciaries that we work with, not only I think we're missing opportunities, but we're also missing an opportunity to protect our clients, because so much of the marketing that's done now is direct to consumer. So somebody's talking to our clients. We got to make sure it's us, and that when the situation arises, that they know who to call and that they're able to reach out to us, because you need that level of expertise. Right? And Evergreen acts as an extension of your team because it's what we're experts in. It's what we do. But it's really important that a client has an advocate and somebody who is going to help them navigate that space. Because if not, I think that's the pitfall, right? That you got to make sure that you're working with the trusted advisor to make sure that someone's looking out for your best interest. I think that's really important. So I think you want to know who you're working with, you want to know who the capital sources are, and you want to make sure that are they representing you or are they representing the investor, right? Who's their responsibility to? And I think that's a great question that you ask if you're dealing with somebody is, well, whose best interest do you represent? And people should be honest and tell you that. And I think too, missed opportunities of, like you said, leaving money on the table. So, if people lapse or surrender their policies because they were unaware of it, one of your big concerns is, what if you don't bring it up or the advisor doesn't bring it up, but then they learn about it after they lapsed or surrender their policy? And they come back and they say, well, could I have done that? And the reality would be like, yeah, you probably could have.
Well, if you're a financial advisor, they have to be huge fans of you guys, because that's just more assets for them to manage, right?
And that's the story I tell all the time. I think it's wonderful because, everybody buys the life insurance to provide that financial stability, right? But because of the emergence of the life settlement space, you as an advisor can now deliver the check when it's needed most.
Yeah.
Right? You can deliver the check. And that might mean that it's got to cover, medical bills. It might be that you want to balance out your estate because you've transitioned your business and you have other children, right? It might just mean that, unfortunately, maybe your spouse predeceased you and the need to continue paying the premiums, aren't a priority, or that the cash surrender value has evaporated because, of a low interest rate environment over an extended period of time. But yes, if you're a financial advisor, you got to ask in the review, right? Do you own life insurance? Because a lot of it's owned, was sold by somebody else. Do you own life insurance? Does the need still exist? Why did you buy it? It's basic field underwriting stuff, but you uncover opportunities, and through those opportunities, now you're going to create liquidity. We had a woman, she had two different policies, both really efficient GUL contracts. One was $4 million, one was $3 million. They both had a couple $100,000 of cash. She had come to her financial advisor and said, I want to move out of my daughter's house where I've been living. It's not working for anybody. And I need some additional liquidity because I picked where I want to move in, right? A new it wasn't assisted living. It was sort of one of those transitional communities. So the financial advisor looked at it, saw that there was money in the policies, and that was going to be the source of liquidity. when they came to us, we started talking about it. And my response was, are you sure she wants to sell these? Like she was 81. She had some health issues. They're really efficient contracts. She probably ought to keep these. And he was like, yeah, you're right. He went back to her. They had a conversation. He came back. As I talked to her, she's selling, now that she knows she can sell them. So we ended up selling those 2 policies for $2.6 million, right? To put a lot of liquidity. They were able to address her living situation. They put a lot of cash into, the financial advisor did, into their managed money platform, and was able to increase his AUM by almost $1.5 million. And he was also able to help the children who were part of that planning. So yeah, there's so much opportunity. If financial advisors ask those questions, treat it like an asset, help them monetize it, reallocate it, supplement other strategies that they have. And also you're not drawing down on their cash either, right? So you're out reallocating premium dollars as well as the new liquidity you created.
We're coming up on our conclusion here. This has been extremely helpful. Is there anything else you want to add before we close out?
I want to thank you guys. I think that this is great. I love telling the story because I don't think, unfortunately, enough people know, and they're not thinking about it as an asset, and they're certainly not thinking about it as perhaps one of their most valuable. Nobody has to be an expert, right? All you have to do is realize that the word change has come in, right? If you're an attorney or a CPA or a P&C agency, and if you're working with business owners and it's being sold, think about the life insurance. If you're a financial advisor and somebody's struggling to create liquidity or pay premiums, or it's a term policy that is coming up on its conversion privilege, they have no intention of converting it and keeping it. What sort of strategies can we employ to sell that and create economic benefit? So I just think there's a lot of opportunities. We want to include life insurance in the conversation. And the first thing is just recognize it and then call you guys. We have a wonderful tool called an MVP. It's a market value projection. All we need is an illustration, a date of birth, and typically within 48 hours, we can run a market projection for you to show you the value of that policy at 4 different life expectancies. And that way you can, one, confirm viability, you can manage expectations, because that's always a popular question. Well, what do you think it would be worth? I won't hold you to it, but what do you think it'd be worth? So I think that those, using that tool to appraise policies or include it in the evaluation of any type of meeting that you're having. And it also, for advisors, helps you expand, the conversations you're having. Because if you're talking to is sort of that trusted authority that wants to be the trusted advisor, this is a great content to be able to talk to CPAs and attorneys about, because they may know it. Human nature says if we're not, experts or we don't know a lot, we don't talk about it. Great, I got a guy. This was awesome. I really appreciate it. Hopefully,
Thank
I
you
didn't
very much.
talk
Super
too
helpful.
much.
Your kids should give you some props now for being on a podcast.
They were
Super
very impressed.
Yep.
They were very impressed when I told them.
Thank you, Brendan. Brendan Flatow with Evergreen Settlements. Appreciate it.
Thank you, guys.
Bye. Goodbye.
The material and opinions voiced are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine what is appropriate for you, please contact a member of our team.